First, to introduce myself, I'm Rhona Driggs. I am the CEO now of Empresaria Group, just under a month or two, I think. Time goes by very, very quickly. A little bit about my background. I've spent the last 29 years in the staffing industry, really working all various sectors throughout the staffing industry, all with publicly held international companies. I'm super excited about the opportunity to present to you today, talk to you about our strategy, things we're doing different to try to reinvigorate the revenue and certainly the profitability of the group. And my background is very diverse, but I especially have a passion for sales and the operations side of the business, and very, very hands-on. Used to being very hands-on in the business, and will continue to be hands-on in the business. So that's a little bit about me. Tim?
Yep, I'm Tim Anderson, so CFO. I've been with Empresaria a little bit longer than Rhona has, but only still 17, 18 months. So I started in March 18. My background is predominantly listed businesses. It's not recruitment, but I've got a lot of listed companies experiences from Into Properties, Alliance Boots, and ITV back in the day.
So with that, we'll go right directly into the slide deck and start with slide 3. For those of you who are not as familiar, we now have 5 sectors and we'll talk a little bit about that new structure and what we're doing and the reason behind the alignment into the sectors. Currently, we have over 1,950 employees operating in 21 countries. Part of the benefit of our business model, of course, is the spread of operations, reduces the impact from localized market issues, which we will be talking about as well in this presentation. 67% of our net fee income does come from outside the UK, which I think that picture was different in the past, and it was more heavily weighted toward the UK. So we're seeing some diversification outside of the UK. We have growing strength, as you will clearly see in our results as Tim goes through the numbers, in our offshore recruitment business. And that also helps with the diversification because it is and for those of you who are not familiar, I'll kind of start with the offshore recruitment businesses in India. We now have 1,000 people in India that are providing recruitment services to staffing companies. So both in the US and the UK. The US business is a little bit bigger than the UK business. The UK is predominantly focused on the healthcare sector, while the US for our offshore business is recruiting for a variety of roles and supporting a variety of different staffing companies in all sectors: IT, commercial, engineering, and professional. So you see we're 55% temporary, 38% permanent, and again, our offshore is about 8%. Going into the overview of the half year, you'll see that we have had solid growth in net fee income of around 7%. And a lot of that, and Tim will dive deeper into these numbers when he goes through the financials, but we did see a 55% growth in our offshore recruitment services sectors. And having come from the US market, I can tell you that the U.S. market is very much embracing offshore services, and it's quickly spreading to other parts, and certainly the U.K. has leveraged that to a large degree, and there are a lot of staffing companies that we're supporting here in the U.K. as well.
Tell us a little bit about more what you mean by offshore recruitment. Is this where companies in the U.K. are outsourcing to India and work is being done out remotely?
Yes, so if you think about the recruitment business, what they look to do is utilize offshore services because the cost is certainly much more attractive. And so what they do is, instead of hiring recruiters in the UK that sit in the UK, they hire those recruiters with us in India. And those recruiters support the recruiting life cycle. Sometimes it's just the sourcing piece where they'll source candidates to the local offices and then the local offices will pick it up. And sometimes it's complete full cycle where they will actually source, submit, and go directly into the clients with the candidates.
So what we're not doing, and some people do misunderstand this, is we're not recruiting people from India to place in the US and the UK.
Right.
It is recruiting people, our teams in India are recruiting people based in the UK and the US to work for UK and US companies. So it's a proper outsourced service.
So we have had a fall in profits for the first half, and that was expected. We had a lower starting point for our temps in Germany and Japan following the legislation changes last year. And for those of you who are not familiar with that, there was legislation changes in Germany and Japan around the length of assignment that temporaries could be on assignment. And then we also had I guess it's called an equal pay scenario in Germany, which caused clients to really kind of stop using temporaries and just hire direct. So we are recovering from that, but we're also seeing some secondary headwinds in Germany. One of our businesses is doing really well. The other one, fortunately or unfortunately, is heavy in the automotive sector, and the German automotive market is proved to be a bit challenging. But we have taken actions. We'll discuss that in a little bit. And then the impact of Brexit uncertainty in the UK markets overall. Our UK markets actually performed well compared to our competitors. But when you look at there are certain sectors, the home building, which we provide salespeople for the home building, as well as the financial services sector, did have an impact on us for half one. So wanted to talk a little bit about what's different. What are we doing differently? And, I came into the group as the COO back in November, specifically with a charter to drive organic growth. But, one of the things that I first, really needed to assess is how healthy were the businesses. And what I mean by that is you can have a business that throws off a lot of profit, but they may not be very healthy, right, underneath the hood. And so given my depth of experience, I went into a lot of all of the operations actually, and started to really understand: do we have first and foremost the right structure, given what we're trying to supply in the marketplace? Do we have the right mix of clients? Is our client base diverse enough? What is our sales process? We were from a group perspective not really driving a sales organization. And so my charter was to build a sales organization, right? To get everybody thinking about sales, growing revenue, increasing profitability. So part of the challenge with that, as you all probably know, is you look at all of our brands and we look a bit disparate, right? We've got brands, a little bit of brands everywhere. We've got pilots, we have healthcare, we have doctors, we're a little bit of everything. I always try to look for synergies, right, and try to understand how do we leverage or harness the power the group has. What's the benefit to the brands of being in the group? Are they realizing that benefit, and are we helping them grow their business? And I think because we've kept the central team in the past so lean, and our former leadership did a great job, I think, of going out and talking to the brands, but really couldn't give the depth of really understanding what's happening in the business. Is this okay? They might be great today, but are they going to fall off a cliff next month? And what are we doing to make sure that we're building healthy, strong businesses? So in May, we launched a Stronger Together initiative at our group conference, and really, took the opportunity to, talk to the MDs about, why it's important that we work together and that we collaborate together and that we find synergies with our businesses, and that we have cross-selling opportunities, and we can leverage maybe operational efficiencies within the businesses. And a great example that I like to use, because it just helps clarify it a little bit, is back in February, I want to say, I had a meeting with 4 of our largest brands in the UK. And one's in IT, one's in marketing, one's in engineering, and one's in professional. And I had them bring their client lists to the meeting, and top 20 clients for each brand. There wasn't one overlap, but from brand to brand, which is just crazy to me. I call that low-hanging fruit. So, we were doing business. Most clients are going to have staffing needs in all those areas, but yet we're only servicing them maybe in just IT or just in marketing. So we started a cross-collaboration effort where we started to say, hey, look, and what's the benefit to the brands, obviously, is they're getting introductions into each other's clients where we've already built trust and confidence with those clients, and we have the opportunity to really leverage and get more sticky, if you will, and create barriers to exit with our clients versus being just this transactional business. So that's the best example of what I can tell you about maybe the gaps that were in the business before, and that we really were running. And we still, our MDs are still, I get this question a lot, we have a management equity philosophy. They are running their business, but we have a majority stake in the business, and they have benefits to gain as well if the Empresaria stock price, does better. So there is benefits to them working more collaboratively as a group. I think we've pretty much covered this slide, but wanted to just give you a little bit of flavor of what we're doing differently. We have been opening new offices. You'll see that we opened an office in Austin, Texas, and in 2 locations in Brisbane and Auckland. Thank you. And we do feel that we're on course to deliver full market expectations. Again, we're more heavily weighted always and have to, and we're confident in that. So strategy and delivery. This on the surface doesn't show much change in terms of the overall strategy, but what's underlying is very, very different. How we're looking at building size and scale within our existing markets and taking some of our core leading brands and scaling those to other geographies going forward. And again, focusing on that organic growth as opposed to the next acquisition, and keeping focused on reducing the debt and, of course, improving productivity. If we go to slide 7, we've aligned, and you'll see the graphic. And in future presentations, we're going to get a little bit more away from the brand, because the important thing should be the sectors and how we're growing those sectors, regardless of the brands or the names behind it. The one other thing that I think is key and what we found, so think about many of these businesses were acquired or started when they were really small and growing. And what happened is over the course of time, administrative burdens started to become very real. HR, legal, payroll, billing, compliance, all of those things. So one of the things that we are launching, Tim's taking a lead on this, we're taking 3 UK businesses this year and kind of consolidating or providing a shared service approach to billing, to payroll, to credit and collections, so that we can start taking the administrative burden away from our MDs to allow them to focus on sales. And believe me, they're not fighting us to keep it, because it's noise, it's things that they have to deal with, and it's keeping them from being client facing. And to have those replicated across 20 brands is crazy. So we are, it'll be it's evolution, not revolution, certainly, because we need to take it slow and we need to make sure that we do it right. But the goal would be that we do have a shared services. It won't be additional headcount, because we have the headcount already in the brands. It's just consolidating that and making it more efficient, and of course, hopefully, better quality as well. We talked about the end of last year, we started investing in a central team. The key thing is, if you think about marketing, just take something as simple as marketing. Marketing is critical in the staffing business, right? It's not as much anymore from a sales standpoint as it is from a recruitment standpoint. How are you getting the candidates? How are you doing, how are you handling your social media? What are you doing with your job boards? The second highest cost in any staffing business besides the staff is the actual recruitment. The actual recruitment costs itself of job boards, marketing, et cetera. So what we've done, many of our brands either had no marketing support, or they had their own full-time marketing people or part-time marketing people. So we've invested in a couple of people who have consolidated a lot of the marketing across the brands, and not only have helped us reduce some of the overhead in some of the brands, but have allowed us to do group buying, right? So it's much different if a tiny little brand goes out to Career Builder to buy, some job boards than it is if we say, hey, Empresaria spends X amount of hundreds of thousands of dollars in recruiting, give us a deal. So we're doing a lot more leverage buying now. And then the same thing goes for training. Training, we had some brands that didn't have any training support because they were too small. We had other brands that had dedicated trainers. Some of our larger brands still have dedicated training, but now we have core content, because there are core things in recruitment and sales that are must-dos regardless of what it is you're selling and what market you're in. So we're providing that level of support now. Talked about the structure and the reorganization. We are taking action on underperforming businesses very swiftly. The new offices we touched on. We also launched Forward Talent and Council, scaled to Austin. So we are taking, and you'll see that in Tim's presentation, we We bought some additional shares in Consul recently, and that has been a brand that has performed really well, and so we're scaling that business now. And one of the things as well that will be a focus for next year is to really focus on the U.S. temp market, because Consul has been really perm focused, and so diversifying that business, again, another thing where you go in and say, great, you're doing great on perm now, but what happens when that goes away? So how do we start to diversify the business? And then last but not least, we'll talk about technology. So technology, if you read any of the press releases on staffing companies, I don't care who it is, they're all investing in technology because speed is key. You've got artificial intelligence, technology is changing daily, rapidly. So we have signed a deal with Bullhorn. I'm not sure if any of you are familiar with Bullhorn, but they are a leading software provider in the recruiting staffing space, both for front office and back office, or front office and sales. And we're putting those in some of the brands. So instead of, again, every brand going out and buying a different technology and spending money for it and not really knowing what they're doing, we are really collaborating with a best-in-class partner to bring us along with their technology. So with that, I'll turn it over to Tim for the financial.
So if we just flick over to page 11, if we just go through sort of the overview for the group, we can then delve into it by sector. So as Rhona mentioned, net fee income is positive for the first half, so up 7%, 6% in constant currency, but operating profit is down 14%. On page 12, I've done a bridge of that operating profit, so we can sort of talk through what the key movements are. I mean, there are two ways of looking at it, so I'll go through this way and I'll sort of talk through the other way as well. So 5 million was the operating profit 2018, and then 4.3 for this year. So we talked, of course, before the year began about Germany and Japan starting from a lower base in their temp numbers because of the regulatory changes last year. So that's had a 0.4 adverse impact H1 to H1 this year. Investment in the central team, so that's a 0.4 increase in those costs in the first half. That isn't something that would repeat in the second half because a lot of this investment was made in the second half of 2018, so that would be maybe a 0.1 in the second half, but not any more than that. 0.3 million for the net costs of the new offices and brands that we've launched in the last 6 months or so. Again, that figure will reduce through the second half. I'm not saying it will make a profit in H2, but they should be much closer to break even, and then we'd expect them to start to contribute next year. The first green one, up 0.2, is their first time contribution from Grupo Solomano's. This is our investment in Peru that we completed in July last year. They contributed 0.9 million to net fee income in the period and 0.2 to operating profits. Brexit is the big sort of negative in here, the 1.0 million fall. So that's across the financial services, new house builders and engineering sector. So that's the total which those three businesses have fallen profit-wise year on year. Now again, we've taken a lot of steps in those businesses and looked at the cost bases, looked at how they're operating. So we wouldn't expect again to see that to repeat in H2, although of course what's going to happen in H2 with Brexit is even more uncertain. But then notwithstanding all those downsides, we have seen some strong growth in the rest of the group. So we're 1.2 million positive across other businesses. 0.7 million of that is in the offshore recruitment services business. And then we've got a 0.5 million from other businesses within there. So within there, we do have some, if you like, new costs from the investment central team and new offices. What we're seeing is where businesses are growing. Obviously, they're growing net fee income. They are growing their cost base as well to support that, but they're maintaining their conversion ratio. Where businesses have struggled, and this is particularly the case with some of the German impacts and with Brexit impacts, what hasn't happened is costs have not fallen as quickly as NFI has fallen. Now, clearly we are taking actions in those businesses to reduce costs, but there is always a lag. Germany and the UK, you've got redundancy payments, you've got notice periods, you've got a process that has to be gone through. So you can't react as quickly as you perhaps could in other markets, or if obviously you're growing. So those factors are things that we've taken those actions, and we should see an improvement in the second half from that those sort of cost cutting or reorganisations that we've done. If we just go through the group level bits, then we can dive into the sectors afterwards. So just looking at earnings. So earnings per share have fallen by a greater percentage than profits. So this is again around the profit mix between those businesses with the higher non-controlling interests. Now the offshore recruitment services business has a particular impact here because there's a 30% non-controlling stake. They aren't as seasonal as the rest of our business. They don't have the H2 weighting. So the influence of that on the first half is greater than it would be in the second half. So I do expect that gap between the EPS movement and the profit movement to reduce in the second half.
And your tax has, I think, always been relatively high. 35 to 40% is.
Well, if you look at the underlying tax, so before the impact of amortization of the intangible assets, then it's around 36% at the half year. And they have quite a big distorting effect when you look at it H1 to H2, because that's straight line phase, that cost. So it ramps up the tax rate slightly artificially, which is why it's better to look at that underlying tax rate as well. And the two come closer together by the time you get to the end of the year. Then just flicking on to slide 14. So adjusted net debt is 1 million higher than it was at December. Our cash flows are very much weighted towards the second half. So not just the profit being weighted, but also in the first half, we have all the tax payments. We have the dividend payments. We had some more CapEx in India because we moved the business into a new office that can accommodate their growth. And there was some more CapEx for that. But we would still expect our net debt to fall by the end of the year, and that's including after taking into account the purchase of the shares in Console. We to buy those shares, we did activate our extension to our revolving credit facility. So we still are maintaining headroom despite acquiring those shares, and we still have a good level of headroom. We're still looking to reduce the debt. That's absolutely the target. We expect it to reduce by the end of the year. But of course, when we make investments like buying the shares in for Console, that does offset that. But we're not looking at making any significant external investments through the use of debt, because we do want to get that debt down. We appreciate that that's definitely one of the drags on our share price at the moment, and that the market just does not like debt in recruitment at this particular moment in time. Should we go through the sectors? If we start with professional, revenue has dropped quite significantly. There's a twofold factor in here. It's all really around our aviation business. Partly it's around just a change in billing approach. So some of our pilots moved from one base to another. On the first base, we run the payroll and pay the pilots and then bill the whole lot to the client. The second one, we run the payroll but pass the information over and they actually pay the payroll. So therefore we only bill the net. And because of just a slight change in responsibilities and the risks around it, etc., we don't gross up the revenue. So the net fee income is not impacted by that change, but we don't show the revenue. So the revenue's dropped. And that impact is around, I think it's 4 or 5 million from that change.
Has Rushworth worked out as expected when it was bought? I realise it was probably slightly.
Yeah, I think so. Yeah, and its profits have grown in the period we've had them. And we said at the start of the year that we expected it would have a more difficult 2019, and that is the case. And that's because of they have 3 to 5 year contracts for their pilots. So as you go through the cycle, they've got an awful lot of people with one client.
Right.
So we've seen that growth, and now we're going to see some of those pilots start to drop off. So that's the other cause of why the revenues dropped in the first half. What we have seen, though, is they've gained some more ancillary revenue, which has partly offset that at net fee income level.
With those, are you talking about retiring pilots, or would they not move on?
No, so they move. They typically move to the airline on a permanent deal.
Okay.
So the airline at that point will take them on permanently. So we are working within that business to diversify the sources of revenue to open up new options.
We've been strictly focused on pilot leasing models, and there is a demand for, especially in the UK and Europe market, to do more permanent placement of pilots versus the contract leasing. So we are actively looking to hire people here in the UK that are going to help us develop that, and again, help us diversify our revenue in that business. But again, thinking about the synergies, and I just want to make this point because I think it's so relevant. When you look at the pilot business, then it's just the pilot businesses kind of stand out amongst all of our other brands. But the conversations I've been having with the MD is let's get into the mechanical engineering side because FastTrack can support that. They won't deliver it, but how do we? Again, you look at that opportunity in Latin America. We're doing ground crew. You start to really peel the onion and you start to understand that there are opportunities. And while we think that, when I first came into the group, I thought, well, pilots, well, how's that relevant to anything else we do? But in fact, there's some opportunity there to leverage some of our other brands to get their foot in the door with Rishworth and then vice versa.
And then just going down through professional. So net fee income has grown, and that's despite the challenges from Brexit. So some of our businesses, such as in the domestic services business, has done really well. Net fee income in our aviation business has actually grown despite the drop in revenue. But overall, adjusted operating profit is flat, and that's just going back to that point about where we've been impacted by Brexit. Costs haven't gone down as quickly as the revenue has, and so that's something which in the second half has to we've taken measures to address that and bring those more in line.
And that's primarily the financial services business here in the UK, along with the home builders. We provide salespeople for the home builders, new home builders.
So on the next page we have IT. So Japan, obviously we talked about the regulatory changes last year, starting from a lower temp base. What we found though is that rather than rebuilding the temp base as such, actually we've seen the change in the market, so there's more permanent revenue coming through. So revenue has fallen in Japan, but actually net fee income has held fairly steady because we're picking up more permanent work. So that business actually is doing better than maybe we expected at the start of the year. The UK is doing very well. We've seen a very strong performance in the UK, but that's been offset by a weaker performance in the US. They started the year, the cryptocurrency market, which they were very heavily into, had sort of really dropped off, and it's been a challenge for them to rebuild that revenue, looking at other markets and other sources. But overall, the IT sector is doing well for us. Adjusted operating profit is down. That's the impact of having the new brand and the new office that opened in April. On the next page, we have engineering. So this is had a very difficult first half. Majority is UK. We do have the small business in the UAE as well. And really what we're finding is the challenging market. A lot of people are going to administration that are our potential customers or actual customers, and an ongoing impact from Brexit, which is impacting both the roles that are available, but also candidates, because a lot of people working in this sector do come from Europe. We have taken steps. We've hired a new leader for this business. We're doing some significant work on restructuring, both in terms of the team and how they're going about things, but also the market they're targeting, and looking more at the white collar end and the more skilled, more technical end of the market. So we do expect those changes to start showing a benefit, although H2 is likely still to be difficult. We should see some positives coming out of that into next year. Onto page 23, we have the commercial sector. So this has benefited from first-time contribution from our investment in Peru, which is doing very well. They're winning new clients at the moment. They've had a very, very positive start to life in the group. So the underlying revenue and net fee income has reduced, and that's really driven by that German market. So although we've had the regulatory changes last year, and so we're starting from the lower base, actually that isn't the factor in our performance. We've recovered very well from that. Our logistics business is doing very well. However, that exposure to the German automotive sector in our temporary business has been challenging. And again, this is a business where we've seen that drop off in revenue not matched by a drop in costs, and that's the work that's been ongoing that will come through and see some benefits in the second half. On the next page, we have offshore recruitment services. So this is a very, very positive slide. We'll maybe linger on this one a little bit. This is a business done really well for us, and of course it did have a very strong 2018 as well. It's growing both in its UK and US market, so we're seeing growth across the board. we invested in new premises at the start of this year that's enabled it to continue to grow its base. And in fact, we're already talking about taking another half a floor in that building because they grow their headcount so rapidly when they're winning clients. I mean, you can win a client and suddenly it's 50 new seats you've got to fill. So they always have a bench of people that they've trained that they're waiting for a client to go on to. So they're always, really trying to keep that moving very, very quickly.
What do you think's enabling them to win these new clients? Is
I
it
think
standing out in the marketplace?
Well, there's always an increasing pressure on margin in the recruitment business, and that really is something that they can really help with. And a few years ago they were relatively small, and so for them to demonstrate the value they could add was perhaps more difficult. But now, 1,000 people, some of their clients stay 100 seats. The biggest one is 100 seats, and then typically they'll be around that sort of 30, 40 level. And actually that's an important part of it. To get the real benefits, you need some scale with them. If you just have 2 seats, you're not going to get the benefit as if you have maybe 10, 12, because what you have there is your own little team, and you need to go and visit them and spend some time with them and train them in the ways of your organisation and how you want them to interact with your clients. And I think as much as anything, they've just they've got the hang of that model, if that makes sense.
And they've got some good offshore sales advisors, and even I have been intimately involved with IMS and helping to introduce them to my contacts in the U.S. And there's a presentation in Detroit in a couple of weeks to another big client. So there's they've got good sales momentum right now, and I think with the pressures that are happening across the U.S. and the U.K. and margin, the demand is just growing, and people are realizing that it's much more cost effective to try to do this in India than it is to try to build it on their own.
The operating margins, both against revenues and also if you use the net fee income line on profit relative to that, are just phenomenal.
Really, really good margins.
I suppose the worry is that it's not sustainable.
Yes, absolutely, and there is a currency exposure there. So clearly, depending on where we go with Brexit, that could impact their sales to the UK. But actually, sterling would have to go down quite a long way before it caused it could wipe out their profit, but it's unlikely to be in a position where they would generate a loss from their UK business. So yes, it is good margin. It might get more competitive. There are competitors in the market. I mean, there's one in particular that operates not too far from where they are that is a strong competitor. But so far, the service they're providing has enabled them to maintain that.
What's the working capital characteristics of that business?
How does
it differ?
It differs a little bit in that we're not paying temps and then billing, but what we are doing is paying staff. So in a way, it's quite similar. So you're paying your staff straight away, and we've got a lot of staff there. Yeah. And then the payment terms are 60 days typical, I think. Okay. Yeah. So they are on relatively.
And you're saying it's a fixed fee that it's paid.
Yeah.
You said $1,000.
£1,000, roughly.
Roughly.
$1,200
I mean, some are
maybe.
higher, some are lower.
Yeah. And we do hedge once we've billed, we do hedge the FX just to minimise the risk around that.
What level are you targeting your debt to come down to?
Well, we talked about getting it down to 25% of trade receivables level. So we're at 38 at the half year, I think. It's a tricky one because I personally, I don't really see the debt as a problem because it's not something which we're having any problems with the covenants. We don't have any issues in terms of headroom. In the event of a downturn, we'd expect some of our working capital to unwind and we'd be able to pay down the debt. But we're very conscious that it is a drag on the share price, and that's really important. So that's as much as anything, that's the driver for looking to get it down. I think if we've got it to less than maybe one net debt to EBITDA, I think that would be a good trigger as well for people. If you can say 0.9 rather than 1.3, then that I think feels better. But if we can get some of that organic growth growing and get the debt down as well, then the ratio starts.
I guess it gives you a window. You mentioned the focusing on the internal rather than external acquisitions. It gives you a sort of window to really focus on that.
And that's exactly what we're doing. Yeah.
No.
Did you have any pleasant surprises when you went around the operating companies?
There was lots of pleasant surprises.
Yeah.
But probably the biggest pleasant surprise is the buy-in from them on the things that Rhona's been talking about, because actually, the old model was very much letting them operate on their own, and we still do have that autonomy and etc. But it's more about now helping and supporting. But I guess we both, when we started, had the impression that there would be some resistance to more support.
They wouldn't want to talk to us. They wouldn't want our help. They wouldn't want to, and it's been completely the opposite.
Yeah.
I mean, completely the opposite, which is really refreshing. And I think we are very focused on turning this into a sales organization. This is a sales. We're doing things that may sound basic to people, but we're doing leaderboards now, scoreboards, ranking reports. So we get the competitiveness between the MDs going, and this is a sales business at the end of the day. And I'm working really, really hard to put that sales culture back in place in the brands, and they are embracing it, and they're a really great team. I mean, we have to, I look at every single one of our leaders, and they are all really, really good. I think they just need support, as you do, and when you're out there running a business, and we're in a lot of emerging markets, and that's tough. They've gone out there and went into markets where they really have had little support, and so. It's really has been a pleasant surprise that they have embraced it the way they have, because again, we thought, we were under the impression that they would just shoo us away, yeah.
And the 5-year plan has just finished. Are you going to be quite public about a new 5-year plan?
No, we weren't going to put another 5-year plan out. But some of the measures that we're in there are still things that we're aiming towards. So the 20% conversion ratio is still where we want to get to. The 25% debt ratio is still a valid point for us to aim for. And I think we also talked about growing NFI by 10% each year. So again, that is where we want to get to. Mm-hmm. But rather than putting it out as this is where we're going to be in 5 years' time, and essentially getting shot down if we don't achieve it, I think that's what we're aiming towards, and we're happy to say that's what we're aiming towards. But we're not going to put a 5-year timescale on it.
IFRS 16 has mucked up calculating free cash flow.
It has absolutely mucked it up. I'm not happy about it at all.
I dislike it, but especially it won't help your EBITDA numbers when you're looking to buy out the rest of Console, because it'll have boosted your EBITDA.
No, we're okay. We're protected against that.
All right. so just on that slide 27, you've got 3.8 million of cash generated from operations. Really, I need to deduct the 3 million lease payments, the 3.8 for tax and interest, and the capex of 1.1.
And add back the pilot bonds outflow.
To be fair, if I was looking to be fair.
If you're looking to be fair. I mean, well, you want to be fair or not is up to you.
If you did add them back, essentially more or less free cash flow neutral.
Yeah, so it's about, I think it was about 1 million or something, is what I calculated. But yeah, depending on how you measure it, but fairly neutral in the first half. And that is typical. And we are so second half weighted. And as I say, those tax payments are very first half weighted. And we did have the finalisation of a tax audit in Germany that we paid for in this first half, and that was sort of €1.5 million, for example, which was catching up the last couple of years, which had been provided for. There's no P&L issue, but it's I mean, free cash flow should be broadly in line year on year. If you're doing after tax, then it might be a little bit lower.
Yeah.
So I think, first of all, I'd like to say thank you, because again, it's great to meet all of you. I look forward to delivering results. I hope your takeaway is that we are taking measures to improve our growth, improve our profitability. We are very, very focused on organic growth and increasing our shareholder value. And we look forward to your support. And I think we feel like we have taken the right steps to get us in a better place, especially as we go into 2020.